Hey everyone, welcome to Cigars and Syndication. I'm Robbie. I'm here with Jay, where we're passionate about real estate and we're passionate about cigars too. Today we're gonna talk a little bit about the current housing market and maybe some of the shortages and how we might get caught up.
Hey everyone, I'm Junaid, and welcome to Cigars and Syndications. Yes, we are passionate about cigars. What are we smoking today?
Today we've got the Padron Family Reserve 85-year anniversary smoke. I mean, really smooth, easy draw, typical Padron.
Yeah, I mean, I love the way these things light up, and I love the way they draw. But enough of the cigars. Let's get into our topic today. So we've been seeing housing go up and down. What's going on with the shortages in housing? We've been seeing it all of last year, 2023. We're seeing shortages in multifamily housing. We're seeing shortages in single family housing. So let's talk about that a little bit. Let's see what we can how we can inform our listeners, and what kind of conclusions we can draw.
And it's kind of tricky if you're sitting there and you look at the numbers as they are without kind of taking the situation and as its whole. I mean, we're starting out with a shortage of multifamily and single family homes. So even in the event that we surpass the number that's needed annually, we still are in a deficit because of the shortage.
Yeah, so if you go to weareapartments.org, it's a non-for-profit organization that monitors the demand for apartments. And they are estimating that we need nationwide, we need 266,000 apartments annually in order to keep up with demand based on, new people entering the market, and the expansion of the population as it is.
So even though I think in 2023 they eclipsed 400,000 units, there's still a deficit because of the past years where we had shortages.
Right, and that deficit goes back to 2008, the 2008 crisis. Real estate kind of came to a stop to a standstill. Banks stopped lending, developers stopped developing because there was too much supply on the market, um, and as a result, we haven't caught up with that oversupply, which then turned into a deficit.
Well, and for me, where it's the most noticeable and the most impactful is, historically, interest rates and home prices have been indirectly related. They react when the interest rates go up, home prices typically come down. But because of the shortage, the home prices have stayed steady and in some cases even increased over year.
So yeah, according to the latest data that I have from RealPage, single family homes were up 32.9%, so almost 33% year over year. Multifamilies were down 26%. Um, but here's the thing: single family homes are up 40%, but so are interest rates, and so single family homes are not really affordable unless they fall within a certain price range, and especially in Houston over here, um, single family homes that fall within a $300,000 range are can be affordable. But if you start looking, and again, real estate, as you know, is very, very local, right? So we can go look at the Woodlands, we can go look at Sugarland. Those houses are $500,000-600,000, are not affordable by any means by the average person.
Yeah, no, they're not. And with this shortage, as developers, I mean, I think you've kind of got to open your mind and listen to some of these newer ideas out there. I'm very old school and I have a hard time making these changes, but there's some things on the horizon that will probably impact this industry at one time with not only with the things going on in the financial world, just the labor. There's a real labor shortage that can really impede progress for these developers and I think that there's some modular construction that's out there, and now you've got the commercial real estate world colliding with the residential real estate world with the conversions of office space.
Yeah, and if you take into account the shortage that we've been running year over year since 2008, and you combine it with higher interest rates And then, of course, if multifamily is down another 26% and interest rates are high, so people can't afford single family homes, that just basically says that multifamily, there's going to be more, obviously, there's going to be more demand for multifamily. There's going to be more construction on the horizon, but nobody wants to get their feet wet in the construction until interest rates drop. And a good sign that the Fed just offered yesterday was that they're not increasing the rates, but they're going to hold them steady, and they don't think they're going to drop them at least until May.
Well, I'm really excited with what I'm seeing there, and the economy still seems to be moving forward, and it's really strong. I'm excited about the Fed's response yesterday, and hopefully they do what they say. They start decreasing these rates, and really, that's going to open the door. Hopefully, some people have these projects and they've been holding on. I think there's a pent up demand for development, and hopefully with these rates dropping, it kicks it in gear.
Yeah, and I know I've always maintained that the bond market is smarter than the stock market, and right now the 10-year bond is at 3.87. Um, and so it was at a little over four at the beginning of the week. So, since those bond yields are dropping, I think the market is expecting the Fed to drop the rates sooner than they're saying. I think Powell's a smart man. He did a good job of engineering this soft landing. We didn't have a hard landing. We didn't have, like back in the 80s where interest rates were up in the 15% for a long period of time. The economy is growing, but at the same time, inflation is dropping. And I think he's not showing his cards. I think he is going to start dropping in March. They just don't want to get everybody all, riled up about it right now.
Yeah, and I think that lends itself back to the commercial real estate market. I think there's billions of dollars out there that these interest rates are greatly impacting the outcome of these properties, and hopefully they're farsighted enough to realize that they need to bring these interest rates down, help some of these deals get done, and keep this economy moving forward.
Well, with the office space asset class coming to a halt, basically, right? A lot of people are either going back to work in a hybrid manner, a few days out of the week, or just working from home remotely. So even though office space is still needed, but a lot less is needed. And so, what are some of the challenges that developers like us face if we try to, get a good deal on an office building and maybe convert it into apartments? Because that's where obviously, you know, it's going to be necessity, right? It's going to be where the demand is, and the next step would be is to buy office space and start converting them. So, what are some of the construction challenges that we'll be facing?
Well, just like we always preach, do your due diligence. I think there'll probably be some good opportunities, uh, but most of the time, these office buildings are in populated areas. Probably a lot more zoning in other cities besides Houston. Make sure that you can get this thing permitted for a residential tower, and then you get back into the infrastructure. You're going to have quite a bit of demo and build back. You always have the challenges with utilities, water connections, power, those types of things. So again, do your due diligence, build a good architectural and engineering team, and move forward with caution.
Yeah, it's going to be a very interesting landscape for office spaces, especially when you have big corporations like Blackstone Group and Boston Properties surrendering their keys to the bank. And I think the metric that I read was that 40% of all 43%, actually, I'm reading it right now, 43% of all office spaces, or 43% of all deed in lieu of foreclosure, which is here's the key, don't foreclose on us, uh, was office spaces. 43% were office buildings in Q2 of 2022.
Yeah, and that's a scary thing, and I think they'll also, with those sad stories, I think there'll be some opportunistic people out there that will turn these and convert these into multifamily units, maybe even convert them to hotels, and get in the hospitality industry. Hopefully, there's some good groups out there that take these buildings over.
But do you think it's easy to convert an office into a multifamily? I mean, usually offices have one or two bathrooms on each floor, whereas in a multifamily, you're going to require, a bathroom in each unit. We're not going to have, communal bathrooms.
Right, right. No, that wouldn't sell very well anywhere other than maybe some student housing. But yeah, there definitely going to be some plumbing and electrical challenges. There's definitely going to be some engineering, some structural things that you're going to have to work through. And each of these buildings is its own unique, uh, animal, and you're going to have to approach them all individually. But the ducting, getting all your HVAC to these units, and just the division of the floor itself, elevators. You have a lot of different concerns. So hopefully they can navigate those and do it within budget so that these things can have a manageable rents that people are desirable and affordable places to be.
And also the other thing is that the municipalities are going to have to deal with this as well because, when you're converting an office building, which requires a lot less parking space, to a multifamily, which requires a lot more parking space, that parking space may not be available. So, municipalities are going to have to contend with the fact that what do you do?
Oh, I thought that's a great point, Jay. I think that's going to be a challenge. It's a challenge now, even with a raw piece of land and starting out a residential. You have to give up quite a bit of area, surface area for parking. So they're going to have to get creative. Maybe go down. Maybe you knock the first floor out and have a small lobby, and dig down 2, 3, 4 stories, and have underground parking.
So, it's a very interesting landscape because even though the Fed has decided um, that they're not going to be raising interest rates, uh, the cut what? Yeah, and then what was the two, 4.2? So interestingly enough, Robbie, the 2-year bond is still at 4.2. That means we're still inverted. If the 10-year bond is at 3.8 and the 2-year bond is 4.2, the market is still predicting a recession. And then the 30-year mortgage rate is still hovering over 7%. And usually people are not jumping into the market, and so that goes back to my prediction of if the 30-year fixed mortgage doesn't go below 7% and we are not building as many apartments, rents are still going to go up, even though more housing is being built. But it's at some point, developers will start offering incentives to try and reduce the price of the houses, um, to try to sell them.
Yeah, and that Jay, that just gets back to the point of the housing prices have remained steady, even with the higher interest rates, because of the shortage. I mean, there's still people that list their house on a Thursday and stop taking bids on a Sunday, and the house is gone. It's a really it's an interesting market, and I think that like what you were saying with the multifamily. I mean, the rents are going to continue to go up. There's still a really high occupancy. There's gonna have to be I think hopefully the feds recognize those indicators that you just talked about, and they respond quickly. And it kind of seems like they may be taking it very seriously. I think everybody recognizes that we're on the threshold of recession, but the economy's still strong. Inflation's in control. I mean, I don't see any reason why they shouldn't drop the rates.
Unemployment is still low.
Yeah, unemployment is low. I think it was under 3%.
Yeah. So, and again, not to get into a political discussion, but people who feel one way or another about the sitting president, the reality of the matter is, if the economy is doing well, the incumbent gets reelected, and the economy is actually doing well. I mean, inflation's under control, and like you said, unemployment is low. There's really not a lot of things to complain about regarding the economy, other than, for us as investors and developers, interest rates are a little too high to start getting into any feasible projects.
Yeah, and just taking 2023 as a whole, I think multifamily starts were down 26%. We're already in a deficit, so we're going to have to play a little catch up. And I know that I've seen and read a lot of articles, and I think the underlying theme for a lot of investors is stay alive to 25. So hopefully, hopefully we can navigate 2024 and maybe get a little bit more construction starts, more developments going with a reduction in interest rates.
Absolutely. Here's the other thing, though. The other caveat to this is that there's going to be a lot of existing multifamily whose interest rates are going to start resetting, and they're going to come onto the market. But again, those are almost all of them are occupied. I mean, in Houston, even the multifamily projects that were foreclosed on by Arbor Capital last year, the units or the projects or the assets were foreclosed on, but they were all 95+% occupied. So it's not like a house where a house gets foreclosed on and it's now empty and it's available to live in. There's no B or C class properties that have any occupancy in Houston that I know of.
Right, and the other problem that Houston and Texas and as in whole is facing is we're having an influx of out of state, and for every relocation from out of state to Texas, they're taking a house off the market. But the flip side of that is they're not putting one on the market, so they're just taking supply, right? They're just taking a supply without selling a house. So it really puts a dent into the supply.
And the existing homeowners who are sitting, and I think I read an article that said that 60% of homeowners are sitting on mortgages that are under 3%. Hell, I'm sitting on a mortgage under 3%. I'm not about to let that go and pay 7.5%.
Well, Jay, it's a very interesting time. I'm feeling better and better about the direction the Fed's going. I was worried they were going to maybe react too slowly and or react too aggressively and continue the rate increases. So I'm really pleased with how they've handled it. And in my opinion, it looks like we're going to avoid a recession, and I think that'll really get things fired up, get some good development started. I think you're 100% right. I think there'll be some existing multifamily units out there available, and hopefully everybody can get creative and work their way into the commercial office building space that may become available. So there's going to be some interesting things happen in the next year.
No, I agree with you. Again, the bond market, the 10-year bond is dropping steadily. It's kind of fluctuating, but it is dropping now. That inversion is still a problem because that inverted rate has predicted a recession every single time, except once, I think. And we actually had another podcast where we talked about that. So until that 2-year bond drops below the 10-year bond, there's still a chance of recession. And I think that Powell's doing a good job. And I think he might just be able to engineer a nice, soft landing and start cutting rates and the economy starts booming. And, maybe we're back in the 90s. And a lot of our listeners may never, they were probably too young, but the 90s were a great decade.
Well, we've got some good articles on the '90s. We've got some good articles that were just posted. So jump on albanyparkcapital.com, check them out, and leave any comments or questions you might have, and grab a Padron Family Reserve, and you won't regret it.
This is not just a family reserve. This is the 85th year family reserve. So this is celebrating the 85th birthday of the father.
Very cool. All the more reason to grab one and celebrate.
Have a good day, everyone.